Hello, and welcome to the Insurance Asset Risk Asia Forum, an event that brings together insurers, asset managers, and thought leaders to explore the latest trends and opportunities in insurance asset management. My name is Raymond Barrett, Editor-in-Chief with Insurance Asia News. And the topic of the panel today is best practices in asset liability management. And here to discuss the issue, we have three esteemed guests. First, we have Richard Chan, Hong Kong CIO and Asia Head of ALM with AXA, based in Hong Kong. Then we have Clément Bonnet, a principal with Milliman's Life Consulting business, also in Hong Kong. And then we have William Song with MSIG, based in Singapore. So the first question that I'd like to discuss is some of the key issues that are affecting the life market at the moment. So why don't we begin with you, Richard?
Okay, so let me start with the product and how it affects the ALM. So I will say that in Asia, it is a split between aspiration and reality. Aspiration is everyone is thinking about digital, going simple, doing more pure protection because they know that those products are more ALM friendly. And the reality is the Asia market for life insurance is still largely saving driven. The agents need those higher commission to survive, and then people, the public, need simple product for their investment need. So we still see most companies in Asia, they're forced to sell a lot of these so-called long-dated life and saving products with guarantee. And then they face the issue, which is the low interest rate, the capital requirement, the modernization of the regulation. All this make the product more difficult to manage and require more sophisticated skills. So now it's a question of how people who are already strong there continue to be strong, and people who not yet have those good ALM practice to build up that in order to survive in this market.
I see. Okay, good. And William, in terms of the kind of liquidity issues that affect a P&C player, would you be able to kind of weigh in a small bit with your perspective there?
Sure. Thanks, Raymond. As we all know, over the last 12 months or so, the entire world, including insurance industries and as well as life insurance and non-life insurance industries in Asia, have gone through very much a shock on insurance product perspective as well as the investment point of view. So maybe possible to begin with, rather than jumping straight into the investment and liquidity, I can start off with some background as to what we've been facing pre-COVID-19 that leads to more interesting points that may arise from investment point of view. So I'm more or less generalizing here because we are looking at many different countries from P&C perspective in Asia. But in general, over the last 7 or 8 years, there has been a gradual and continuous softening of the insurance market, where there's been oversupply of insurance companies trying to grow in this Asian market, bringing the prices down, and the profitability from insurance point of view has been gradually declining. In fact, in 2019, it was the first time where Singapore insurance, non-life insurance industry as a whole actually recorded a loss. So what that really meant was that we are almost getting or right in the heart of the soft market in Asia and P&C. And then a lot of the companies were able to actually supplement the absence of insurance profit being generated from the soft market by having a very healthy investment returns coming from equities and bonds, and to a certain extent, relatively high interest rates that we were getting from term deposits. So that's essentially what was happening until around January last year. But immediately after that, as we all know, February and March, there was a very much a drastic shock to the investment market. Equities have tanked. interest rates have gone down so rapidly, and then there's been a gradual increases of recoveries from equity and interest rate at the same time. So what it really meant was that from investment point of view, it really meant, rather profit point of view, insurance companies were really had to think about how to generate sufficient returns, either from investment or insurance side, that will satisfy the shareholders' expected return when the soft market of insurance is not really providing sufficient return. At the same time, the sources of revenue from investment side has depleted, at least temporarily. So it really puts a big question mark around what our next steps are from both investment return as well as the liquidity point of view. And I guess there'll be questions for everybody, whether it's life or non-life or Asia or outside of us. I'm very much looking forward to discussing a very good discussion with my fellow participants here to really figure out and what the views are from the rest of the market.
It's scary. So it looks like the trend is people rely on investment margin to cover the high combined ratio.
That's right.
So the worst case is the P&C firm become an investment firm.
So Clement, so all of this now, obviously with all of these changes over the last year, like what kind of impact or what kind of issues do people need to think about in terms of, say, interest rates and, say, volatility management?
Yeah, so maybe just before answering your question, just to supplement on what has just been said, I suppose there has been a few key changes recently. So one is around regulation. So Richard mentioned capital regulation. I think accounting regulation is another key aspect. So we are moving from managing a kind of traditional balance sheet, which wasn't really moving. So the asset side wasn't really moving, the liability side wasn't really moving, to a balance sheet where effectively both your asset and liability will move at the same time. So that's obviously a key change. On top of that, as we've said, with COVID and with all the shock in the economic environment, the environment has become much more volatile, not only the interest rate environment, but also the equity environment, and this needs to be managed. And finally, a third impact is really the policyholder impact. In some of the market, in Asia, in Hong Kong in particular, but in other market, products have been sold on a promise that customer will get a very high return in the long term. So this needs to be managed carefully, and this is obviously more difficult to be managed under a more volatile and risky environment. So you also need to take into account this customer angle. So if you take all this into account, obviously interest rate risk management is becoming more and more a key topic, with the idea obviously to manage shareholder return, so the volatility of the shareholder return, but also to manage the customer volatility, so what you're going to pay to the customer, and manage the policyholder reasonable expectation. So, to answer your question, I think historically, interest rate, management and LM in general was very much focused on duration matching. So companies were basically reporting duration mismatch, and that was probably it. So they wanted to make sure that this duration mismatch wasn't too material, and there wasn't any material incentivized to reduce the duration mismatch. But with the change from a traditional balance sheet to an economic balance sheet, actually interest rate management and interest rate volatility management become much more important. And as a consequence, LM needs to be much more sophisticated in order to be able to manage this kind of new economic balance sheet.
Okay, well, talking about things getting a bit more sophisticated, then maybe I thought, Richard, you would like to maybe talk about the use of, say, derivatives to kind of maybe help in this kind of complex situation.
Yes, it's a good transition because Cayman talking about go beyond duration gap management. So of course, before I talk about go beyond, firstly, we need to manage the duration gap. At the end of the day, it is the first order primary risk. I saw many people talking about the difficulty of matching duration. I would say that at least for some economies, like US dollar or Europe, is about how much work you're willing to do than whether the market itself is practical to match or not. So let's say if we are on a regime like Solvency II or the future Hong Kong RBC, there's some accounting tricks like the last focus point, which artificially reduce the liability duration. So it will not be that long. And on the other hand, if you are, say, a US dollar or European dollar, Euro dollar investors, you get access to a very wide fixed income market together with a very well-developed derivative market. So everything up together, it is, my experience, it is really practical to manage duration gap targeting zero. So take US dollar as example, you have lots of tools. You have the typical interest rate swap, you have the government forward bond, and you also have, for some people who are willing to trade futures, the US Treasury futures. Then depends on your accounting need, you may favor one instrument versus the others. As long as you know how to use these instruments and you know how to cover those derivative specific risks, like the counterparty risk, like how to deal with the collateral liquidity issues, then it is perfectly fine and practical to match the duration gap.
Okay.
If you ask me, my day-to-day challenge is not duration gap. It's about the total balance sheet. In particular, both the capital shock and the actual interest rate movement are beyond the so-called small movement that duration gap can capture. So people should look at, for example, complexities. They should use instruments like options to reduce those second-order risks instead of just looking at duration gap.
I see. Perfect. Very, very good.
Maybe just one point to add on this particular topic. I mean, just taking one step back, I think the trade-off is really around maximizing the return and minimizing the volatility. So obviously there is no free lunch. So I would be pleased to say to client, look, you can maximize both, but actually in practice it doesn't really work that way. So you really have this trade-off, and you need and management need to decide whether they prefer having higher return but potentially with higher volatility, or lower volatility with potentially giving up some of the return. So I mean, this is true for hedging, this is true for LM in general. I think in the past a company were much more focusing on return because volatility wasn't really managing volatility wasn't really incentivized by the regulation, so there was no incentivized to reduce the volatility. Going forward, they will be incentivized to manage volatility. So the trade-off will be much more, it will be less difficult to say which part of the trade-off will be preferred. But I suppose from a management point of view, that's really the first question. And then the next question is, and this is related to what Richard said, is you also need to define what are your key metrics. So what are the metrics you want to define? And depending on the metrics, you may have different answers to your LM problem. So if company focus on return on capital, then they may worry a bit more about volatility. If they focus on long-term insurance value, then short-term volatility may be less an issue. So that's a kind of other angle to take into account when we discuss this kind of topic, even before going into the detail and the solution to manage the LM.
But if you don't mind, I go a bit far. It's more than just choosing between risk and volatilities. It's also about the type of risk. So if you hear what I say, I match duration, I match complexity, look like I'm a typical actuary that is very risk averse. But I do that just because I want to free up my room to take risks that I know how to take. I don't want to predict the interest rate movement, which no one will be correct. I want to take some other investment risk that I'm confident in, and in order to do so, I hedge the risk that I'm not good at predicting.
Okay. Well, as I said, these issues are on their own complex, but I think what's also very key to stress is that Asia is a very diverse market with kind of very much different economies in different situations. I wonder, William, if you'd be able just to give us an overview of sort of how all the issues that we've kind of discussed so far are playing out currently in Singapore and in the wider ASEAN region.
Sounds fine. So I guess as far as non-life insurance is concerned, the concept of matching is somewhat there, I must say, but not as a discipline as we might practice in life insurance. So what I mean by that is a lot of the insurance liabilities in non-life insurance sector, maybe outside of Australia, are typically not discounted. So what it means is that the movements in interest rates typically do not have a direct financial consequence as far as reporting is concerned on the liability side. So what that tends to do is insurance companies can be quite badly mismatched, either consciously or subconsciously, where the asset bond duration is significantly longer than the duration of the liability. And the liability duration in non-life insurance, of course, are drastically shorter than what you see out of life insurance. So what that really means is that some of the mismatch risks that may exist may not be so evident from a day-to-day investment risk point of view. Then we combine that topic with what we are going through right now, where it's a low interest rate environment. And at some point in time, interest rates will go up. And then you combine that further with the fact that the absence of insurance profit will induce non-life insurance companies to take extra risks on investment by either lengthening their bond or investing in lower quality credit rating bonds. It really amplifies the investment risks, and you will actually, the results will actually come through when the interest rates go up. So it's been hard to really predict exactly what will happen, but the current position, I'm really generalizing here, is that there is probably an increasing mismatch of duration between asset and liability in a low interest rate environment. And then 3 or 4 years down the track, when interest rates go up, that consequences will actually become a bit more real in Asian market. And then I guess the question that I have, I mean, more of a personal curiosity is, this is something that we see in non-life insurance, but I would love to find a little bit more about it. Is something that has been echoed or something that you see commonly in life insurance as well, whether this conscious or subconscious mismatching is happening in outside of non-life insurance, actually.
But by the way, different for P&C is debatable. It depends on whether you look at balance sheet or P&L. You look at balance sheet, taking excess asset duration, create volatilities. But if you look at P&L, we take excess asset duration, it means more predictable investment return over time because there's less reinvestment. So there is always some point to debate to allow P&C company to take a bit more asset risk, asset duration. But if you ask me for life company, it is usually the other way around. So life company, many people in particular, those are not sophisticated in derivatives, find it not possible to match the liability duration. So they will just claim, for those people, they just claim because it's not possible. Whatever I want to do is irrelevant. I just take some duration mismatch. And by the way, interest rate is low now, so I'm doing a good decision because interest rate go up, my reinvestment can get high returns. So that is the general story I hear from here and there from all different companies.
Right, I see. Okay. So obviously, in terms of some of the other kind of issues that are affecting different jurisdictions across Asia, Clement, I'm wondering if you'd be keen to talk a little bit about Hong Kong and maybe some of the issues that are kind of unique to this jurisdiction, perhaps the kind of unpeg issue, for example. And then maybe afterwards we can go and maybe talk some more about ASEAN and China. But maybe if you'd like to begin on Hong Kong.
Yeah, definitely. So I mean, two topics. So one is economic balance sheet. So just to echo what has just been said, I think there is no one economic balance sheet across the region. So Hong Kong is probably, I mean, the Hong Kong capital basis is probably the basis which is the most in line with an economic balance sheet basis. But if you look at other countries like Thailand, like China, I think asset and liability are not always valued on a kind of consistent basis. So this also introduces some issue when you do your LM, because the question then becomes, do you do an LM based on an economic capital basis, or do you do an LM based on a statutory basis? And then you may have different answer in terms of duration mismatch, in terms of complexity mismatch, and so on. So I think that's also a very important point, and that's often what companies found very difficult to manage. So effectively in some market, you've got like 3 or 4 different bases to manage. You've got a capital basis, you've got a statutory basis, you've got an IFRS basis, you've got a tax basis, and each basis may have different answer from an LM point of view. So yeah, I think that's also a very, very important point to notice. On your question on FX, yes, definitely FX is a key topic. I think historically, FX risk has been almost 100% risk managed by companies. So in other words, company didn't have any appetite for FX risk in the long term. It was not seen as a rewarded risk in the long term, and therefore it was fully hedged. Given the economic environment, given the the political environment, I think this risk is seen as a key, even more key risk in Hong Kong. And in Hong Kong, the depegging between USD and HKD is obviously a scenario which is considered by many companies. So I think so far historically company in Hong Kong, just to give some background, so company in Hong Kong were selling HKD products. So on the liability side, it was on the HKD, but on the asset side, they were buying USD assets. So because of the mismatch between asset and liability, company were buying FX hedge to convert the asset side into HKD and therefore have no FX risk. So this has been the strategy of companies historically. With this risk of depeg, companies start thinking about other approach and potentially taking some exposure to RMB, for example. But again, I think it's still at the early stage of the development from what I can see. And so far, I think the statu quo is still to fully hedge HKD versus USD using FX hedge.
Okay, very good. And I think that's a very kind of handy segue over to Richard, maybe to talk a bit about China as well.
Yeah. Before going to China, maybe I can supplement on Cameron's point. So I am the typical people who rely on the US dollar market to back the Hong Kong dollar liabilities. So my baseline assumption is sooner or later I should hedge. Now the question is how to find the best entry point. Both in practice or doing some historical backtesting, we find that a pure mechanical hedge is highly suboptimal. Another tiny technical detail is the so-called cross-currency swap for people who know about derivatives can be broken down into 3 components. One is the pure FX component. Second is interest rate differential. And third is basis swap. So what we find is if even we have the aspiration to fully hedge the FX exposure, we wait for those individual components to be attractive and lock them in one by one. I could do one first and leave the other open for a while. That significantly reduces the hedge cost, and in fact, in FX, we get so-called hedge premium. That is, we get paid to reduce our risk. This is another example that if we are less lazy and do a bit more work, we can optimize. Now, go back to your question. So actually, Cayman already gave the answer. So different jurisdiction has very different regulations. So Hong Kong and China, although it's the same country, we have very different regulation in place. Hong Kong, after we move to Hong Kong RBC, will be Solvency II-like, market consistent. So in theory, people need to be prepared to manage the ALM just like, if I say like long short hedge fund, the liability is the short and asset is the long. How you manage the long short difference, decide what risk to take and what risk not to take. For China, it's still more traditional. So the ALM is more talking about cash flow matching, make sure the asset can accumulate enough return to pay for the liabilities. The regulation asks people to ignore the signal given by the market. So for example, when credit spread widened, the Chinese insurers are not that hurt because it means lower asset value, but higher future returns. So again, there's no right and wrong, whether it's market consistency is better or the traditional cash flow match is better. But for China's case, there is a strong need to avoid unintended volatilities and to avoid unintended panic by the insurer if the market moves too drastically. So it means the traditional way could be a sensible way for the current status of China.
Okay, very good. Now, obviously, one thing too that's coming in the next couple of years, there's like an expected wave of offset regulation, things like IFRS 17, various RBC regimes. So, William, as a chief risk officer sitting in Singapore, I'm sure you're looking out across the kind of ASEAN region. I'm just kind of curious how you go about kind of looking at those issues from that kind of multi-jurisdictional approach, basically.
Sure. My role as regional CRO, whilst we look at risks that are regional specific, but our typical approach is probably to look at an individual country by country level, because whilst it is a regional portfolio, they do have individual countries have a very unique features that we need to recognize and respect. So I'll be starting off with the individual country by country point of view, but there are some general trends that we see if I extend the time horizon rather than just last 12 months, let's say last 3+ or maybe even 5 years rather, looking at RBC2 and then some of the changes that's been put through in capital requirements to begin with. Before that, a lot of the RBC requirements, if there was one, like in say Singapore or Australia and Malaysia, the capital requirements for insurance companies taking investment risks were what I would call pre-Lehman Brothers asset charges. So before 2007 and 8, we probably could anticipate equity market tanking by 40-50%, but it happened, and it happened again during the COVID-19 correction in Feb and March last year. So a lot of the RBC2, including the ones in Hong Kong, are now recognizing a very hefty capital charges on equities and some of the unrated bonds. So what that means is that now it creates it really stifles insurance companies now, particularly for non-life insurance. Now, once again, going back to the soft market where there's absence of insurance profit, for companies to take extra risks on investment, they are going to be penalized very, very heavily on their solvency at the same time. So it makes it hard for insurance companies to take the extra risk they would have been able to take before RBC2. Because now, I mean, the charges vary, but equity, for example, will be attracting 30-40% for every dollar of investment or of capital charges. And that is very hefty compared to what we saw pre-Lehman Brothers or the old RBC, where you're getting something like 16-20% risk charges. So that general theme is there. And I'm seeing that, of course, in Singapore, obviously in Hong Kong, Australia, Malaysia, and Thailand. So it makes it harder for insurance companies to do what they were doing in the past. So Is that a good thing or a bad thing? I think from with my risk management hat on, I think it's a good thing, because insurance companies, and I guess this is the area where we could differ between life and non-life insurance. When it comes to non-life insurance, our core expertise is to provide financially sustainable insurance products, and then investment income is really there to service extra returns for shareholders if necessary. By having these extra capital charges, it more or less forces or put pressure on insurance companies to focus on their core insurance competencies. So that would really mean that companies that were operating more on a cash flow underwriting basis, that were supplementing profit from mainly coming from investment, would no longer be able to survive, or find it very hard to survive and generate sufficient returns whilst maintaining sufficient capital level that will satisfy the regulators. So once again, I'm sort of very much generalizing it, but I think that is more or less the thing that we see that I typically observe in non-life insurance industry in the Asian market.
Okay, good. Clement or Richard, anything to add on that topic?
But besides the capital charge, the IFRS 9 and 17 are also pushing for the same direction. So in the old day, people can use the check fair value OCI to hide the equity-related volatilities in the IFRS. But now they have a difficult choice, either put in fair value P&L to observe all the volatilities, or put in fair value OCI, but you cannot recycle the realized gain. So there will be some permanent loss.
Okay.
I'm more luxury because I am mainly covering life entities. So I have the so-called VFA in IFRS 17, and still allow me to take more equity risk than P&C firm.
Okay, good. And Simon, anything to add before we come to the final question?
No, I suppose most of the thing has been said. I guess from a regional point of view, and that's echo what I said earlier. I mean, the issue is that you really have very different balance sheet basis depending on the country you are looking at. So, and it's becoming even more difficult for regional team or group team to really understand what's happening locally, because every single market in Asia have their own regulation, and even like small changes. So, for example, on the liability side, none of the market across the region has the same discount rate. So obviously it seems like a minor change, but it actually creates quite a lot of discrepancy between asset and liability, and therefore make the LM process more difficult to manage from a regional point of view. So hopefully in the coming year with ICS, or the International Capital Standard, with IFRS 17, we expect those gaps to be reduced. But as Richard said earlier, I suppose some regulators, some market will still push this kind of differences forward, just to make sure the insurance industry is sustainable and doesn't collapse. Because the key thing is, historically, I mean, a lot of products have been sold with high guarantee. So if you move overnight to a kind of pure market consistent framework, then it could create issue from a capital point of view. So you have to recognize this kind of local specificity, but same time from a kind of a group or regional point of view, it's quite difficult to navigate, just because regulations are very different from one market to another.
Okay. And just to wrap up and to finish up what's been a very interesting discussion today, I'm going to invite our three panelists to look into their crystal ball and make a prediction, a short prediction for the future, something that we are, at least something that we should be keeping our eyes on for the rest of the year. So who'd like to go first? How about Richard?
Okay, so I try not to pretend to be an economist, so I won't predict what the economy or what the market will happen. But no matter what the market will happen, people's experience in 2020 or even earlier now demonstrated the market is highly unpredictable. So if you ask me to predict the practice in the insurance industry it means people will take less so-called beta market risk to bet on a single benchmark index, for example, to bet on the interest rate or to bet on overall outperformance or underperformance of the equity market. People need to be focused on alpha. So within interest rate, which part you want to take, what risk you don't want to take, and within the equity market, what type of equity you want to buy, what type you don't want to buy.
Okay, perfect. And how about William?
All right, so this is a very, very interesting question, ways to wrap it up. I'm going to make a very straightforward, but might be a very naive prediction. So given that we are operating in a very low interest rate environment, I'm going to predict that interest rates will go up at some point in time over the next couple of years. And then combining that with the fact that insurance companies are taking extra investment risks on the non-life insurance side with mismatched asset duration, where asset duration is longer. When the interest rates go up and when the yield starts to steepen, in non-life insurance companies will actually begin to suffer on the investment side, start to report losses. And if that happens after the introduction of IFRS 17, there'll be a big a dip in the ROE return coming up because of that sudden shock of the positive news that comes from the economy, where the economy is now starting to go back to its normal growth phase, and then subsequently leading to a strengthening of the interest rate that ultimately leads to a shock in the company's asset profile, especially for those who had a longer asset profile relative to the liability.
Okay, very, very good. And the last word I will give to Clement on this.
Well, I suppose the last the thing we haven't covered is credit spread and credit spread widening. So I guess one of the key questions is whether credit spread will continue widen or whether they will narrow in the future. And associated to that, there is a question on whether there will be more default on corporate bond or still the same level of default. And obviously, depending on the answers, this could have some potentially material impact on the insurance industry. And I mean, another topic is around private equity and all non-standard growth asset. I think on the life insurance side, I mean, companies have been buying quite a material proportion of this kind of asset class over the past few years. So I mean, similar to credit spread and credit spread widening, I mean, I suppose there is a question on whether this, I mean, the return experienced by this kind of asset class will continue going forward, and whether we will see some kind of default on private equity and this kind of risky asset class, which will also cause some issue to some of the companies in the market.
Okay. Well, those were three very interesting predictions, and you'll have to join us next year just to find out exactly if they came true or not. So with that, I'll bring an end to our panel. And again, I'd like to thank our three esteemed guests for taking the time to join us today. And thank you very much.